Every month, I get passive income from my dividend income stocks, and here's some of my biggest payouts. But here's the truth, showing you doesn't actually help you right now. So let's rewind. If I had to start fresh right now with no portfolio, no head start, here's what I do. In under 9 minutes, I'll show you how you can invest $6.50 every single day to make $1,000 a month forever and tax-free. The 5 simple steps to build passive income that pays you money while you sleep. I also share 2 beginner-friendly Canadian Dividend ETFs that pays you money every single year just for holding onto these companies. This is not financial advice. This is for entertainment purposes only. Hey, it's Tracy. Just in case you don't know me, I'm a former engineer turned full-time business owner, investor, and a mother of twins. Over the past 20 years, I've been investing in stocks and real estate, building a passive income portfolio. And I get to share it now on YouTube so that you can learn a lot faster than I did. Now, dividend income companies are simply companies that pays you every single year just for holding on to the company. And in Canada, we have many examples, which are utility, financials, energy companies, some of which I'm sure you use on a daily basis, and I will share it over the course of the video, what they are. But before I do that, I want to share that most Canadians are paying unnecessary taxes holding on to dividend income paying companies just because they're using the wrong account. So the first step is opening the right account, and that is the tax-free savings account. The tax-free savings account is perfect for holding on to Canadian dividend paying companies. Let's look at Royal Bank as an example to see how you can tell if it pays dividends. If you look at Royal Bank, it shows a 2.96% dividend yield. That means if you invest $100 right now, you get $2.96 per year just for holding on to that company. For optimizing taxes, avoid US dividend income stocks in your TFSA. The best account for that is the RRSP, unless you like paying holding taxes to the US government. For example, if you buy Apple, Nvidia, which are very popular tech companies that also pay you income, the best tax optimal approach is holding them in your registered retirement savings plan so that you avoid paying taxes to the US government. How to get started in 2025? I really recommend starting really small with something boring, plain vanilla. It's something that's like a basket of companies so you're diversified. A really popular one that tracks the Canadian stock market is XIU, which holds 60 of the biggest, most important companies in Canada and many you're familiar with. We're talking banks, utilities, energy companies. The goal is to get started with something really sleepy, boring ETF like this one. And surprisingly, it has performed quite well over the years. Over a 10-year period, it has returned over 10% annually. If you're looking for a Canadian boring ETF, another one that's good long history of performance is XIC. XIC holds 230 of the biggest companies in Canada, so it's much more broader. I'm going to show you how this compares. With XIC, you can see the dividend yield is 2.3%, while XIU is 2.5%, but the average range is very close to each other. Both of them have very low management fees. The fundamental difference between these two ETFs is XIC is much more oriented to capital growth versus income growth, which is XIU. And that's why you'll see a little higher performance with XIC while more income being paid out by XIU. But both of those are very popular ETFs in Canada that also pays you income, making money while you sleep. Now, when I'm looking for Canadian dividend paying company ideas, a tool I've been using over the past year is the Moomoo app. I love seeing everything in one place and being able to then buy the stock really quickly. The dividend yields, the history of how reliable this income is, what is the performance over time, and whether each of these companies have been growing their dividends over time. So no more jumping through apps. I've been just using this tool, which is the Moomoo app. And this has been game changing for me because it's saving me so much time, and most importantly, it's free. Talk about the 2 things you must absolutely avoid when choosing companies to invest in. Most beginners love the annual income. It's addictive. And they start with a dividend yield of 8 to 10%. The thing is, there's no free lunch. Let's use an example. I'm gonna hop into BCE, which is Bell Mobility Company. Now, if you look at it, the yield looks great, but look at the stock chart. It's been going down, and here's why. You could see that the dividends got cut in its past history, even recently, which has affected the stock price. One metric that's so fundamental is the payout ratio. The payout ratio is simply telling you how much income, percentage of income, the company decides to pay out to you. Putting it very simply, payout ratio is like equivalent to you collecting a monthly income going to your job. And if you used more than 100% of your income to pay rent, you could easily see how this becomes unaffordable. That's the same with a payout ratio. If you see a payout ratio over 100%, that means the company is not making enough to pay out its dividends. And that's what happened to Bell Mobility. A very good practice is to avoid dividend paying stocks that have a payout ratio of over 80%. Anything greater, you're at risk of the company cutting its dividends and then sending the stock crashing, like it did for Bell Mobility. And avoid companies that don't grow their dividends over time, especially when you're young, and have a yield that's reasonable. I'd suggest starting with something at least 3 to 7% and has a reasonable payout ratio of less than 80%. By the way, there's an opportunity to make 50% return on investment today. If you invest $100 and open a trading account in Moomoo, you get $50 cash back instantly. That's free money. Plus, if you don't know what to do with the money and you drop in $10,000, you can put it into a cash account and you get 6% annualized interest over 2 months just for holding that money into that account. Check out in the links below in the pinned comment. Now, as promised, I want to share how you can make $1,000 a month forever. The goal of first year is really to get you started. That's why I'm recommending investing $6.50 per day. That's like $200 per month. Year one, you need to open a tax-free savings account and invest $6.50 a day, equivalent to $200 a month, into something very boring, plain vanilla, that tracks the Canadian stock market and pays you income, like XIU. And if you did that, you'd be collecting annual dividends of $74.70. In year two, you're gonna up your game because you wanna invest a little bit more. You're gonna find the equivalent to less than $10 a day, which is $300 a month, and you're gonna contribute now $3,600 in that year two. And again, invest in something plain vanilla, XIU. You're now gonna collect a dividends of $100.91. Year 3 to year 8, you keep continuing doing the same. And then year 10, we're gonna up your game to invest $7,000 a year, because now you're gotten to the habit of taking per your paycheck, auto buying XIU, and then investing it. So let's find some more money and start putting in $7,000 a year, which is equivalent to less than $20 a day. And that's the most you ever invest for the foreseeable future. You can see if you keep doing that until year 10, and you take those dividends that you collect, the income that you collect, and keep reinvesting that into the same ticker symbol, XIU, it compounds, and your total contributions, the money you paid into it, is $178,000, and the portfolio value is now worth over $500,000. And you get paid annual dividends of $15,000. And you can see that as you hold on to these dividends, it starts compounding faster. By year 40, it'll be worth $32,000. By 45 years, it's $47,000. You can see the exponential growth and the hockey stick moment where it starts flat and then starts increasing really fast. Now, here's a general rule of thumb. If you invest $100,000, you can expect receiving $12,000 a year, equivalent to 4% in a dividend income paying company. If this is too slow for you and you don't have 30 years and you want to grow your wealth and income much faster, then definitely check out the video below where I show you how to retire faster in Canada. I also share another video for all the newbies, the one ETF I would hold forever, tax-free. Anyways, I hope to see you in the next video. Bye.